The stock market likes inflation, but only to a point. Inflation and the market both seem very high this year. Is that a reason to be concerned? Maybe yes, maybe no. Think about it like this. Let's say you own stock in a shoe retailer and you sell about 100 pairs of shoes a month, the typical price being about $100 a pair. That means that your shoe company has sales of $10,000 a month. The stock price will reflect a business that has $10,000 a month in sales. Now let's say because of inflation, shoe prices go up to $150 a pair. But because of inflation, not as many people are buying shoes, so the number of pairs that you sell drops to 80 pairs. Well, your gross revenues actually increase from $10,000 to $12,000 because even though you sold fewer pair, you got more for each pair such that overall you have a 20% increase in your gross revenues on a monthly basis. This increase in gross revenues is reflected by the stock market in the stock price immediately. So the market likes inflation up to a point and will drive stock prices up. That's what we saw the entire second half of 2020, and we're seeing that now again this year in 2021. Will it continue on to 2022? It's hard to say, because the stock market likes inflation, but only up to a point. So let's go back to our shoe store. Let's say that because of inflation, the price of shoes has gone up to $200 per pair. But also because of inflation, it's driven down the number of pairs that you sell per month to 40 pairs a month. Well, the gross revenues have now dropped to $8,000 a month. The stock market reflects that immediately in the stock price of your shoe store, and we now see a 33% drop in the value of that company. We've dropped 33% from the $12,000 down to the $8,000. So if this is a concern for you and you'd like someone to take a look at your stock portfolio to see whether or not it's the best thing for you at this time, that's why we're here at Taylor Retirement Services. Just check us out online or pick up the phone and give us a call. We'd be happy to help.